Welcome to this video from Kepsfield Academy. In this video, we'll explore the bonds and their valuation. A bond is a financial instrument through which a bond issuer and bondholder form a legally binding relationship. The bond issuer is obliged under agreed-upon conditions to return the borrowed sum of money to the bondholder at a specified time in the future. Next to the initial borrowed amount, bond issuers can be obliged to make interest payments at a specified interest rate to the bondholders on predetermined time intervals. Some common terms related to bonds include face value, maturity date, principal payment, coupon payments, and coupon rates. In the context of bond investing, the face value of a bond, also known as principal value, par value, or nominal value, represents the amount of money that the bond issuer agrees to pay back to the bondholder upon the bond's maturity. Maturity date is the date at which the bond issuer makes the last payment to the bondholder. Principal payment is the amount of money owed to the bondholder, often repaid at the maturity date. The coupon rate is the annual interest rate paid on a bond, expressed as a percentage of the face value. Coupon payments are intermediate compensations paid to the bondholder during the life of the bond. Note that while the coupon rate is expressed as a percentage on an annual basis, the coupon payments can occur during the year, for example, per quarter or semi-annually. In the context of bond investing, yield to maturity, YTM, is a measure of the total return an investor can expect to receive if they invest in the bond at its current market price and hold the bond until its maturity date. Yield to maturity takes into account the bond's current market price, its face, par or principal, value, the coupon, interest payments, and the time remaining until the bond matures. In other words, the yield to maturity is similar to the internal rate of return of an investment project, assuming the investment required and the cash flows that are expected in the remaining lifetime of the bond. The market rate is the interest rate at which bonds with similar risk profiles sell in the financial market. Bondholders use the market rate to compare it to the coupon rate of bonds. If the bond is yielding less than comparable securities, then the bond will be seen as less attractive to the investors, consequently driving down the bond's price. If the bond is yielding more than comparable securities, then the bond will be seen as more attractive to the investors, consequently driving the bond's price up. The difference between the coupon rate and yield to maturity rate is important for assessing a bond's attractiveness to investors. If the market rate is equal to the coupon rate, the bond sells at par or face value. If the market rate is higher than the coupon rate, the bond will be unattractive to investors as they can get a higher return on similar bonds in the market. The bond price will adjust so that its yield to maturity will be close to the market rate. In this scenario, the bond will trade below its face value or below par. If the market rate is lower than the coupon rate, the bond will be attractive to investors. The bond price will increase, resulting in a decrease in the yield on the bond to reflect the market price. As a result, the bond sells at a premium, or above par, compared to its face value. The various types of bonds can be categorized based on their issuer, maturity dates, or the types of coupon payments. We discuss three common bond types. Pure discount bonds are the simplest type of bonds. They have no coupon payments, and the bondholder receives no cash payments before the maturity date. At maturity, the bondholder receives the principal amount. These bonds often sell at deep discounts, allowing investors to earn interest from the difference between the par value received at maturity and the discounted purchase price. In the case of the pure discount bonds shown, the bondholder purchases the bond for €905.73. The bond matures in 5 years, and the bondholder will receive €1,000 at maturity. The difference between the purchase price and the maturity value represents the interest earned by the bondholder. Level coupon bonds offer periodic cash payments of interest. The cash payment at maturity includes both the principal and interest payment. Bullet bonds are a special type of level coupon bonds. A bullet bond is a bond that pays interest periodically, often at a fixed rate, with the principal payment made in full at maturity. In the case of the bullet bond shown, the bondholder purchases the bond for €954.20. The bond has a 5-year maturity, and the bondholder receives annual coupon payments of 2% of the face value, €20 each year. At the end of the 5-year period, the bondholder receives the principal payment of €1,000. The cash flow received by the bondholder over the life of the bond includes the sum of the coupon payments and the principal repayment. A perpetuity bond, also known as a perpetual bond or consol, is a type of bond with no maturity date, meaning it pays interest to the bondholder indefinitely. In the context of bond investing, perpetuity bonds are unique because they do not have a fixed time period for repayment of the principal. Instead, they pay a fixed stream of interest payments or coupon payments to the bondholder for as long as the bond is held. The timeline shows a perpetuity bond with a principal of €1,000 with 2% annual coupon payments. The current market rate is 4%. The price of this bond is €500. Valuation of bonds is done by the process of discounting future coupon and principal payments by the market interest rates at given times in the future. We use the same formulas for calculating the present values of bonds that were explained in the animation on net present value. The present value of a bond tells us the price at which the bond should sell in the financial market. I will now show you a simple valuation example for the 3 types of bonds we discussed earlier. For a €1,000 pure discount bond with a 5-year maturity and a market rate of 2%, the present value can be calculated using the formula present value is cash flow at T divided by 1 plus the market rate to the power of T. The present value of this bond is thus €905.73. The present value of a level coupon bond, including bullet and amortized bonds, is determined by adding up all future cash flows discounted by their market interest rates. For a level coupon bond with a market rate of 3%, a face value of €1,000, and a maturity of 5 years, this leads to a valuation of €1,091.59. Alternatively, the present value can be calculated using the annuity formula. Present value equals cash flow times 1 minus 1 divided by 1 plus market rate to the power of T divided by R plus the present value of the principal, calculated by dividing the principal amount by 1 plus R over T. This leads the same valuation of €1,091.59, which means the bond sells at a premium to its face value. The present value of a perpetual bond is calculated by dividing the coupon payment by its market interest rate. For a €1,000 perpetual bond with 2% annual coupon payments and a market rate of 4%, the present value can be calculated using the formula present value equals cash flow divided by the market rate. In this case, the present value is €500. To sum up what we've learned in this video, the table shows the common bond types, their characteristics, and the formula for calculating the present value of their cash flow to determine the price. Want to fast-track your finance career? Explore our practical, comprehensive courses at www.kepsfield.com and accelerate your career today.